Welcome, you're watching the Mutual Fund Show. Now, the next 25 minutes, we'll try and explain to you what you should be doing as an investor who's looking to generate and create significant long-term wealth. We often hear about the names like power of compounding, build a diversified portfolio, but the fact remains the starting point of all of this can be rather challenging if you're a new investor. Most new investors in the recent past have been lured by the returns equity markets have generated, but the fact remains that over a longer period of time, it's always good to have an expert help you in that. We have with us Shantanu Bhargava, Managing Director and Head of Discretionary Investment Services at Waterfield Advisors, joining in. Hi Shantanu, thanks for taking the time to talk to us today. Shantanu,
very happy to be here, Samina.
Likewise. Shantanu, the excitement and the euphoria around direct equity is notwithstanding. I mean, investors, traders have generated significant wealth, simply by buying pretty much anything and everything in the markets over the last few years. But the fact remains, and you would agree with me on this, is that for long-term serious wealth creation, consistently investing over a longer period of time is what will help you build a significant corpus. Now, as investors and as the common man, we are told that in order to create this long-term wealth, invest in mutual funds, through SIPs, build a diversified portfolio. But the ideology that is told to us is that the way to do this is by plugging in products across the board, which may not be ideal, right? You want to go in and invest on a strategy, and I know Waterfield does this really well. Elaborate and tell us why simply investing in products and plugging in products in a portfolio may not be the right way to do this. What you want to do is bet on a strategy and go all out.
Sure. So let me take your first question first, which is the choice between direct equities and products. In past 4 years, we've had a stellar run in markets, and investors, especially first-time investors, haven't experienced a deep correction. By deep correction, I mean fall of more than 20%. And we've had shallow falls, and we've recouped very fast. So first up, we've seen a lot of investors putting money into direct equity. There's nothing wrong with it, as long as one understands the business very well. So there's this classic question, direct equity versus mutual funds. So there are two concerns there. First concern is that we've seen investors taking very concentrated bets on direct equities in stocks that they may not very well understand, or they may not be tracking it. So there's a saying that I like, that, I will never own enough of any one thing to be able to make a killing in it. And I will never own enough of any one thing to be able to get killed by it. So large bets on a smaller number of equities certainly generate good returns, and people have experienced it in the past. But holding many stocks more than simply holding a few is a better risk management strategy. So that's the first advice, that one shouldn't be over concentrated. And second point is about consuming the information. So one thing that has dramatically changed in the past 15 years is that information is easily available. Why, as a firm, we actually encourage investors, especially first-time investors, to go with professional fund managers, is because the ability of experts to actually separate noise from signals. So you and I both have the same information, but the way that information is processed and comprehended by an expert is very different, and they use that information to make active changes in the portfolio. So therefore, we firmly feel that at the center of the investment strategy, one should prioritize vehicles like mutual funds, and then selectively in areas where one feels confident, they can also look at direct equities, but very, very selectively. Now, how do you start? Your second question. So process starts with planning, which starts with clearly listing the objectives and constraints. So the first thing that we do when we work with clients is to determine what they're trying to accomplish and how much time they have to accomplish it. Understanding limitations is also important. What really gets glossed over is investors' state in terms of knowledge and expertise. A lot of times investors have just seen returns, and they may not have seen deep down cycles in the market. So that's a very important consideration in terms of understanding and fully fleshing out the profile of the client in terms of their risk tolerance, ability, and also their knowledge and expertise. And then only we move on to the development of the strategy, which first starts with asset allocation. So quickly come to products, but you know, we've all heard of the adage that don't keep all your eggs in one basket. So asset allocation is a smart form of diversification wherein you're actually spreading your investments across different types of assets, different asset types like stocks, bonds, gold, cash, and real estate. Why asset allocation? See, the thing is that theoretically, if you were to just allocate everything in equity and just hold that portfolio in the next 20 years, you will certainly make the best returns. But what hurts investors is price volatility. So given the option, most of us would want to earn a good long-term rate of return with little or no price volatility. But in the real world, we must choose between low price volatility and low returns or high returns along with higher price volatility. By volatility, I mean the daily changes in the value of the portfolio. And that can actually unnerve a lot of investors. So what we have experienced in past 3 decades is that the path of the portfolio returns also matters a lot. So asset allocation, along with diversification, is an attempt to make sure that the entire process of generating returns is more tolerable. And once we have, after understanding and comprehending what the client is all about and understanding their investment objectives, we create an asset allocation strategy. Then we move on to the right security or instrument selection and diversifying, across different types of products.
Shantanu, with one key difference between a young retail investor is versus families is that the very wealthy are trying to preserve their capital and they're comfortable beating inflation and creating a little bit of alpha over the nifty because a large chunk of that wealth is probably transitional in nature, right? Now, with the other type of investor who's looking to create wealth and build wealth, is the advice the same from you? Should both investors be as mindful of their objectives and be as risk averse or risk takers in that sense?
That's a great question, Samina. See, principles do not change. It's important to think hard about protecting the downside because the mathematics of investing doesn't work in your favor. So if markets drop by 50% in a given year, then the markets have to bounce back by 100% just to get back to the previous value. So basically, downside volatility hurts more than upside returns. So which is why, irrespective of the segment, it's important for investors to think hard about protecting their downside and to prioritize risk management along with the return generation. So that does not change. The second thing is that, especially in the case of first-time investors, it's important to think about the whole portfolio construction process in terms of different building blocks. See, one of the advantages that ultra affluent have is that they have access to very high quality advice, which allows them to navigate difficult situations effectively, because there are 3 parts to it. One is planning, then managing the portfolio, and also maintaining the portfolio. Where I find a challenge when it comes to first-time investors is actually the third phase, which is portfolio maintenance. Because if one does dabble into extremely high return generating ideas, it's very important to keep an eye on trends and make adjustments in the portfolio timely, because what we've seen is that when people do get exposed to, let's say, thematic funds or sectoral funds, and we'll talk more about different types of vehicles, they get excited when the returns in the past have been really good. So they look at the rearview mirror and make those allocations. So they enter and exit at the wrong time, which leads to actually wealth destruction. So I would say that in absence of, especially DIY investors, if they don't have access to advisors or they don't deliberately want to engage an advisor, it's even more important to keep it simple and to focus on compounding rather than generating very high returns by getting into product ideas that they don't understand.
Right. So now we luckily have access to you, right? So our viewers can, of
Yes.
course, have that access
Yes.
as we have this conversation. You're right. The very
Surely.
wealthy is an overbanked segment. Everybody wants to give them recommendations, tell them what to do. And let's not forget, they know how to make money. That's why they have gotten as wealthy, right? What
Absolutely.
should, and a current situation at play right now, a lot of people are talking about how the markets are expensive, valuations are stretched. What should a DIY investor looking to do? Should they continue with their SIPs that they do? Should they sit on some cash? I mean, what is the advice that you give the very wealthy that, you know, a DIY investor can also benefit from?
Sure. So first is the time horizon. So a lot of uh, clients that we work with have ultra long-term horizons. They're thinking in decadal terms, 10 years plus. And I would think that that is the case with also first-time savers. They have 20, 30 years to go. So they shouldn't really worry about short-term blips in the market, and wealth creation and generation is a dual pursuit. One is to allocate in the right areas. It's also about investing regularly. So for sure, the practice of SIPs should be continued irrespective of what happens in the market. Uh, Corrections are part of investing. Actually, they should be uh, perceived as an opportunity. But the regular investing program that a investor is following should not be cut short if there are falls in the market. And one should expect volatility once we've had 3-4 years of stellar run in the market. There are a lot that can happen that can spook the markets. But one should continue with their discipline investing regularly. To your question about cash, see, keeping 10 to 15 cash in the portfolio as an optionality never hurts. Once every 4 to 5 years, we get a chance to buy stocks at a discount, when there's a fire sale. So actually, if we condition ourselves to perceive down markets or bear markets is actually an opportunity. One gets an opportunity to pick stocks at extremely attractive discounts that you generally don't find in Indian markets, because of the massive inflows and the stronger relative growth compared to other economies, are perennially slightly elevated in terms of valuations. So yes, please continue with the regular SIPs. Don't be deterred if there is a fall in the markets. In fact, if you have cash, double down and buy more equities, especially horizon is 10 years or more.
Shantanu, I want to, one strategy or one advice that, you know, I know you use and talk about often. And I know it's not one size fits all. So I'm mindful of the fact that all the advice that you give out to clients or your families that you work with or even retail investors is got to be subjective in nature. But what stood out for me is that very often we talk about, like I said, amalgamation of products, right? So you'll see portfolios where you have a few large cap funds, you have mid cap funds, you have thematic funds, you have global funds. And I think investors believe that the way to diversify is by adding more products as opposed to diversifying at an asset level. But what you interestingly talk about and have done, and I've seen this, is where you believe that the way to do this is based on strategy, where you add passive investing, active investing, and build a concentrated portfolio as opposed to owning the market, because if you own the market, you can't outperform. You want to elaborate on this strategy, because this was a standout. Not very often do your advisors build a portfolio on styles of investing in that sense.
Absolutely, Samina. So at a strategy level, first up, I'll take a step back. So we sincerely believe that a healthy combination of active and passive investing is necessary. Even though proponents of both strategies present very compelling arguments for selecting one over the other. So you generally get to hear active versus passive. I think it's an and it's important that a healthy combination is pursued. Uh, I'll just take a step back and talk about active and passive investing for the benefit of all your viewers. So, uh, first, let's talk about a benchmark index. So, benchmark index is a collection of stocks or securities that shows how a given market or a segment of the market is performing. So, for example, the Nifty 50 index includes shares from companies ranked among the top 50 in terms of market capitalization in the country. And Nifty Midcap 150 includes shares from companies ranked among the top 150 in terms of mid-cap market capitalization. Or in the case of bonds, let's also talk about bonds. We have indices like Nifty Bharat Bond Index that measures the performance of all AAA rated bonds issued by government-owned entities. Now, passive funds seek to replicate the performance of a specific index like Nifty 50 or Nifty Midcap 150. It's a fairly administrative work. They're just replicating the composition of the underlying benchmark to mirror the performance of the underlying benchmark. Active funds seek to outperform their benchmark index by making use of the skills of a professional fund manager. So such fund managers carry out active security selection and timing, and these decisions actually lead to a differentiated portfolio from the underlying benchmark. So here's how it works. Let's say HDFC Bank represents 11% weight in Nifty 50, and Axis Bank represents like 3% weight in Nifty 50. Let's suppose we've got two managers. One manager is a large cap active manager, and while the other one is a passive manager. So the active manager believes that from a 3-year perspective, Axis Bank's prices will rise faster than HDFC. Basis his or her belief, the active fund manager overweights Axis Bank in the portfolio, which is to say that against 3% index by 5%, and underweights HDFC, which is to have a slightly lower allocation compared to the index weight. Now, if this active fund manager is right about both his overweight and underweight positions, this fund manager will generate outperformance versus Nifty 50 stocks. But if he's wrong, his portfolio will underperform. So that's the risk that you always face when you are allocating money into active funds. You may do better than the benchmark or underperform the benchmark. In the case of pure passives, the portfolio composition will be similar to the corresponding benchmark, and there's no possibility of outperformance. So at a construction level, we think about different product categories like active funds, passive funds, thematic funds, sector funds as building blocks uh, of an overall portfolio. And as a firm, we found the use of core and satellite method to diversify the portfolio very, very helpful. So, like you rightly said, one size doesn't fit all. So, because one size never fits all, let's start with the core of the portfolio. This is very similar to building a house. When you're building a house, the foundation of the house has to be very solid. So the core portfolio forms the base of a client's investment strategy and should provide stability and long-term growth potential. So the purpose of the core portfolio is to ensure that portfolio grows with the market trends at the least possible cost. Cost is an important consideration, and without any mistakes. And the core part of the portfolio, in the case of a financial portfolio, should ideally comprise of traditional low-cost index funds and ETFs. That should form the base of a investor's portfolio, and I'd say that it can be 30 to 40% of the overall portfolio. Then comes the satellite. Now, in the satellite part, you've got a couple of building blocks. We have two types of active funds, and I know there is always this question mark between mutual funds and PMS, so I'll cover both of them. Within active management, there are two options. There are active strategies that actually endeavor to deliver market plus returns with market-like risk. So basically, they're not taking a lot of risk. They may be taking slightly lesser risk than the broader market, which is measured by different ratios like beta and etc. I'll not go there, but essentially they're trying to beat the benchmark without really taking more risk than the benchmark, and their outcomes are very slightly better than index funds with not a lot of risk. And this bucket is actually filled by diversified mutual funds. And within that, to complement the passive funds, one can look at flexi cap funds or multi cap funds. Because of the nimbleness, they can actually, depending on the way market valuations are in terms of large cap, mid cap stocks, segue between different market sectors and different market capitalizations, and give a good return experience to clients without taking a lot of risk. Then comes the next active strategy, where the primary objective is return maximization, and the fund managers are actually taking a lot more risk than the underlying benchmark. And this bucket is actually filled by, on the mutual fund side, a category called focus mutual funds, and then of course the PMS products that concentrate portfolios and take a lot more risk than the underlying benchmark. So I would feel, for a first time investor, it's important, or someone who's started investing last 2-3 years, to have the foundation fixed, to have 30 to 40% allocated into traditional low-cost passive funds, and then add diversified mutual funds in the flexi and multi-cap side. And if one is experienced enough, if one has seen, let's say, 2-3 market cycles, if one has experienced the COVID fall and did not really exit the market, then one should consider dabbling into PMS products that are riskier. They take a lot more risk in the markets. There's another thought, and I'll like to share that with you. Based on efficiency, the whole promise of active fund management is based on the concept of having some kind of advantage in terms of information. The top 100 or 120 stocks by market capitalization are so heavily tracked by analysts by HNIs, by institutional investors, that there's very little informational advantage to be had. So actually, for an active fund manager in the large cap space, or a strategy which is large cap leaning, to generate outperformance compared to a benchmark consistently is going to be a challenge more and more. And data proves it. Large cap funds, 90% of them have not bet the benchmark in the last 10 years. So it means that if one is aiming for a 50 to 60% allocation into large caps, it's better to build that allocation through low cost ETFs and index funds. Uh, Whereas on the mid and small cap side, where still there's enough information inefficiency, the stocks are not that heavily tracked still. There are a lot of hardworking active fund managers who actually go to the companies and come back, do their primary research, do their channel checks, and come back with information that an average investor may not have. So on the mid and small cap side, it does make sense to pay that higher cost and have allocation to actively managed PMSs and mutual funds. So that's how we approach the whole construction process. But I would say that depending on a person's experience, and overall risk profile, one should prioritize building the core of the portfolio first, which should be populated with index funds and ETFs, and to add diversified mutual funds in the multi-cap and flexi-cap category. And then after some time, once an investor is experienced in a volatility, one can really get into more aggressive strategies.
Right.
There are two more building blocks, thematic and tactical, which we can take up if we have to.
Right. Shantanu, just a couple of, we've got about 5-6 minutes. I'll do a quick rapid fire with you because that always seems to work so we can get maximum out of this conversation.
Sure.
Direct equity or mutual fund for long-term wealth creation?
Mutual funds.
Right. Which market cap is passive investing most suited for? Large cap, mid or small?
Large cap.
ETFs, yes or no?
Yes, 100%.
ETFs or thematic or themes or sector-wise bets?
If one is working with an advisor, for DIY investors, I will advise against dabbling into thematic and sector funds.
What is the ideal number of products or mutual funds should one have in their portfolio, irrespective of the kind of wealth one has?
Not more than 7 to 8 instruments.
Across equity and debt, or would that just be equity?
This is equity. So equity portfolio can have between 6 to 8 funds, and debt, of course, one will have 4 to 5 funds. So equity in isolation, 6 to 8 funds.
For somebody who doesn't have access to an advisor, do you think a good way to do asset allocation could be through balanced funds or hybrid funds?
Definitely. So when I spoke about the core of the portfolio, for a balanced profile investor, that can actually form the foundation of the portfolio, a balanced advantage fund, but a true to label balanced advantage fund. Within that also, one has to really do their research and figure out which one is actually following the whole asset allocation properly.
How frequently do you recommend investors to review their portfolio?
At least once a year, one should review their asset allocation. So if because of market movement, there has been a drift in a particular asset class, then one should arrest it and bring the weight back to the target allocation. So 50 equity, 50 bonds portfolio, if that's become 60-40 after a year, despite the element of taxation, one should bring it back to 50-50 if the drift is significant. If the drift is just a few percentage points, one should ignore. So at least once a year. In terms of managers specifically, please be patient with mutual fund managers. Sometimes the underperformance is a result of a lot of factors which is beyond their control. And I would say that once a manager has been chosen, the manager should be given at least 12 quarters before the manager is fired from the portfolio.
And how often should you look at making changes, and what would be a red flag for an investor to go out and make changes? Clearly not just underperformance, right?
Absolutely. Those are more qualitative factors. So what we do as a firm is we also track changes at an asset management firm level. So if there are any integrity issues or if there are any compliance breaches, those are red flags, and one should think hard about the AMC and the fund. Second, of course, is a lot depends in the case of active fund manager on the fund manager himself or herself. If there is a change in fund manager, then in the least, one should stop allocating more and take a pause and reassess whether they want to continue with the fund after giving it a couple of quarters. So change in fund manager is a red flag in the case of active investing. And of course, if there's any compliance breach or integrity related issue, one needs to reassess allocation to that AMC.
What is the word on gold? How significant or important is this in one's portfolio, given the recent rally, of course?
Very, very bullish in gold. From a long-term perspective, let me qualify long-term as 5 years or plus. With the way the structure is evolving globally, we feel that gold will continue to do well, especially in risk-off environments, and come to the rescue of the portfolio when other asset classes not working. So despite the run-up that we've seen, we continue to be bullish on gold from a 5-year plus perspective.
Shantanu, one skill that you think is most important for an investor to have in order to generate and create long-term wealth, what is your learning?
I'd say it's more of a trait, patience and faith in future, and discipline.
And how important is the cost of investing? Is that something investors should be mindful of, or it's not too much of a concern for a retail DIY investor?
See, one needs to be smart about it. So, like we discussed, in areas where, so one has to think in terms of the return on investment. So, in areas where the probability of cost getting rewarded is higher in terms of outperformance, one should be mindful, but should be liberal. So, like in the case of mid and small cap funds, if one is okay to allocate to active managers, one should go ahead and do it. In the case of, let's say, large cap funds, where anyways the decks are stacked against the fund managers, it's better to save on cost and think about cost optimization. But one should keep an eye on overall portfolio level total expense ratio.
With Nifty at 25,000, lump sum investing or SIP?
I would say that if one comes into money, if there's a windfall, go ahead and allocate at least 25 to 30% immediately, and the rest should be staggered over the course of next 6 months. And if one is continuing with their regular savings plan, one should anyways do that SIP. One should continue with SIPs.
Right. Thanks, Shantanu. It's great talking to you today and help us build some perspective for our viewers. Thank you very much with that.
Thank you, Samina.
Thank you. With that, we're completely out of time. Stay with the channel. A lot more programming on the other side, so keep it with us.